Hello and welcome. I'm Alex Proimos, Head of Institutional Content and Investment Magazine, and this is Market Narratives. This show is a series of unorthodox conversations with thought leaders influencing the world of fiduciary investors. For more related insights and analysis, please remember to check out our website, investmentmagazine.com.au, and subscribe for a free email. And with that, please enjoy this week's episode. My guest today is Jack Gray. Many of you probably would know Jack from his previous roles at GMO as the co-head of asset allocation, the CIO of SunSuper, an executive director at AMP Asset Management, and as an adjunct professor at University Technology Sydney. Jack, welcome to the podcast.
And director of Brookvine too.
Oh, yes. There's many things that you're doing. I know you're semi-retired, but you're still very much involved. You know, how do you think about super funds and whether super funds really are sort of set up to deliver true long-term performance?
The hardest question first, of course, and the question that can never have a particularly strong and convincing answer. But on average, I think they are. On average, they tend to think that way of the long term. I think on average, the industry is now sufficiently aware to know that the difference between long-term and short-term, and how in the long term, 7-10 years, there is some slight degree of predictability of the way markets work. There is an understanding of why equities in a well-functioning economy, you would expect them to outperform by a certain margin. Usually not the margin that people hope for, but margin. That short term, on the other hand, it's a bit of a mug's game. No one can predict what market's going to do in the next year or even 3 years. It's throwing. That's why the throwing darts at a board is better over 1 year than anything else. So I think they are geared towards that. And they've set themselves up. They tend to think that way. Doesn't mean they're always true to that. And of course, the long term always has the problem that the short term can screw up the long term. You can't be there's a misconception, I don't think the super funds have, that the long term, whenever anyone talks about the long term and extols its virtues, they're really saying buy and hold and just sit there. Well, that can't be right either. The short term, as we've seen just recently with COVID, the short term can really play enormous havoc with the long term. So the real challenge is to be a long-term investor, understand why the long term does work better than the short term. On the other hand, occasionally the short term is going to get in the way and you may need to do things. Mm-hmm. There is a tendency, of course, to do too much. There is a part of being a long-term investor is recognizing the incredible virtue of inertia, that doing nothing is sometimes the best thing to do, particularly when we're messed with massive uncertainty. So all those issues play roles that make it a very hard thing to do. Good governments also talk about long term, and they also, the good ones, do tend to think that way and do take actions accordingly, but they too get screwed up by the short term from time to time. So that's the really difficult balance that you have to strike. But they are, when you think of what sort of asset classes should do better over longer periods of time, equity stands out, of course, and they tend to have a bias towards equities, which is generally healthy, but sometimes that bias is a bias driven by the agency cost, that we are doing it because it's more interesting, it's more exciting. But by and large, they've gone into, I think they've invested well in that sense and have done reasonably well. Mm-hmm. You can always say, well, they've done well because the markets have done well, and that's true, but they were there. When you think of the way the super funds started in capital guaranteed, and then they moved into the markets, and then they moved, the big industry funds were one of the first to move offshore in a meaningful way once that was allowed. First to go into infrastructure, all long-term things that I think, have done well.
Mm-hmm. So one of the things that I wanted to ask you around sort of the long-term performance and investing is, there are some big structural changes that seem to be happening with the markets. We've ended a 40-year, downward trajectory in interest rates. Globalization sort of heat to peak level. This windfall that equities have been able to sustain, and a lot of other real assets as well through this period. I guess that's one of the questions that I wanted to sort of ask you in terms of, as we think about long-term performance, has, the best years that we've seen from super sort of, is that coming to an end given the broader backdrop?
Again, another question that everyone's got a view on. Going back in history, which I always do, you find that has been, we have not been very good at forecasting the end of things, and we have not been very good at forecasting the beginning of things. We humans are simply not very good at doing that, and there's always surprises, and it's because of that, the massive uncertainty of the future, which is intrinsic to the future, of course, is the argument for diversifying, that for having some a bit of a few things, and that works, and that's probably the best bet. To make a big bet in a certain way like that on the future is a dangerous thing to do. When I was at GMO in the late 90s, 2000, when the tech bubble was going, we had formed the view that this was nonsense. It was going to end. Our prediction on what the next 10-year forecast for equities was going to be was something like -7 real, and we were much too optimistic. We pulled it back because we didn't think anyone would believe it. We were in a sort of balanced type portfolio, diversified portfolio, where the benchmark might have been, from memory, 55% equities. We were 30 or 40% underweight, which in America, to be underweight American equities meant you were anti-American, which didn't bother me because I am, but it bothered some others. And we were holding this small position on equities. And we went away, 3 of us went away for one full day to argue the case of, if we really believe that this market is going to crumble, and we had good reason for believing that. Reversion to fair value, which we were leaders in. Now everybody talks that way, but we were really the first ones leading that, and we understood how reversion to the mean actually works, probably better than most. And that gave us the sort of theoretical underpinnings for why we believed this market was going to crumble. And so the question was, well, if you really believe that, why are you still holding, say, 20% equities? Why aren't you at zero? And why aren't you shorting equities? And we went away and thrashed that, and we decided we were very confident that this was going to happen. Of course, we didn't know when. We were very confident it was going to happen, but we weren't that confident. There were enough arguments on the other side to disturb us and make us worry. And again, that was part of the diversification argument. That's the big question, of course, of how you size a bet. There ain't no science in that. Well, it's a bit, but it's mainly trying to come to terms with how confident are you and how confident should you be, and why aren't you more confident? And generally, looking at the world in the future, I don't think anyone can have much confidence in any direction on that. So hence you've got to diversify things. You've got to do a bunch of things to hedge that. And there will be some who take huge bets. There's a hedge fund in London that has been underweight. It's been taking enormous bets against the market up until the beginning of this year. They were down 70, 80%. They've probably made some of that up, but you go out of business. There was a Hopkins, I think his name was, in some time in the late 80s, a manager in Melbourne, and he was so sure that market's going to crumble, he put everything in cash, and they didn't crumble at the right time, and he's out of business. So a super fund really cannot afford to do that, and therefore, no matter what you see of the future, you have to diversify. You have to hedge those bets, because you'll never be that confident. I don't know what's going to happen, and all sorts. When you look back in history, it's always a surprise.
One of the questions that keeps coming up around sort of super funds is that they implicitly need to have this sort of a bullishness about markets, right? Because you've sort of just touched on in your conversation there, which is this business premise that they need to manage alongside the investment premise. And you've just sort of given the example with an investment fund, but the same approach would be applied to a super fund as well. Is that fair to say?
Yeah, I think so. They've got to have some sort of view on it. And I'm not saying that because the future is so uncertain and so surprising that you don't have a view on it. You do need to have that, but you've got to be quite cautious about it. And that's part of the skill. It's part of the skill of running a business. You're making a bet on the future, and you want to be able to not put everything all at once on that, and have a sort of diversified portfolio in your business. So our single line businesses, of course, are more vulnerable to really bad downturns. On the other hand, single line businesses have got a huge advantage in simplicity. And interesting on that, at GMO, we as a business, and that's one of the things about investing, is that there's an internal trade-off between running the shop as investment professionals do and running it as a business. It's not unlike making movies or theatre, or even writing a novel. In the movies, you would like to believe that it's an artistic creation, and you want to give the artistic people, the directors and the actors and the others, a whole lot of free rein, because they're the ones who understand how to create art. On the other hand, it's a business. They want to get paid, and so you've got to worry about what's going to make money. And if you look at Hollywood cares nothing about the artistic side of things. It's just a business, and the quality of what they produce is such crap that you see it. On the other hand, there are people like, say, Woody Allen, who emphasize the artistic side more and are less concerned about the business side. But even he has to do that. Same in investing. Are you there as investment professionals, and therefore you will do the right thing that you believe is right for your clients and the investors? Or do you knuckle down and say, look, we've got to do something that keeps us in business and that makes us money? And that may not be the right thing to do. And that's an eternal problem. So when I go back to GMO, we had, as a business, we had a lot of different strategies. You name it, we had it pretty much. And the business idea behind that was that there was something to sell, no matter what happened. It's an age-old strategy. The big guys always do that. Not that we were big, and I enjoyed that, because the trap is that it's much more interesting and even exciting. Well, that means I'm not really thinking about the long-term investor, the client. I'm thinking more about the agency problem, about me, what I want to do, because it's interesting. On the other hand, you went to, and I spent some time with Arrow Street, another quant manager in Boston. Each of us had respect for the other. Quite a different investment way of approaching things than GMO. And from a business perspective, they had decided they wanted a small number of products, small number of strategies. At the time, I think they had 3. They had a couple of equity strategies and 3 equity strategies. That was it. And the advantage of that, the disadvantage if you're a salesman, not that I was you can't, you go in and they don't like what you've got. You can't reach into your back pocket and say, boy, have I got something for you. That's it. On the other hand, as running it as a business, it was much simpler and cleaner and easier to manage and to lead. And so there's that sort of thing is an issue that strikes at the heart of what I'm saying about investors, being an investment professional and at the same time being a profit-making business. It's tough, and the super funds, even though they're not for profit, they have to worry about that too, of course.
Continually worried about their relative performance, right? That's part of these heat maps. It's part of these league tables.
Yeah.
But if we compare that piece, that relative performance versus maybe some of the great investors historically, it seems that there's a bit of a disconnect. Some of the great, investors have some very much fundamentally driven philosophies that they want to invest truly for the long term. And this whole relative performance is really what they would see as a fool's game. They're truly in these particular investments for very large amounts of time. They would also, I would say, take some more concentrated bets. Is there a bit of a disconnect between sort of the business angle, the relative performance, versus then the true great investors of our time?
Yeah, very much so. That is a problem for them because they worry obsessively about relative performance, and interestingly, their clients don't give a damn. I don't think there's any individual member who worries about that, nor are there individual companies who are putting money into super, as from a company perspective, worried about it. It is what it does do is it makes sure that you're safe as a business. The old one that used to be said about IBM, you don't get fired for hiring IBM. If everyone is the same, and they are, the super funds are pretty much all the same. They have different coloured brochures, and that's really about it. There's not much difference between them. Like the big banks. The big banks, they don't really compete. They copy each other, and they have different coloured brochures, but there's no competition there. And competition is a furphy. We're in a business and an industry where competition is really a pointless thing to worry about, because competition works brilliantly with something like umbrellas. Right? Umbrellas, you don't want anything but pure competition with umbrellas. I sell umbrellas, you sell umbrellas. The client comes along. It's pretty easy to tell whether the umbrella is going to work or not. You can even test it, so you can test quality, and therefore once you can test quality, you can decide whether the one that's charging more is actually better quality and make a rational decision. In this business, you can't. You don't know. You don't know what is quality in an investment management strategy or in a super fund. There's no way of knowing that. It's the same with health insurance. To imagine that price determines quality in health insurance is absurd. I've got no idea what sort of health insurance I need, nor will I ever have. And it's a nonsense to do that. And that's why I think the idea of having one or maybe two big super funds, although interestingly, Peter Costello's advocating that, although the future fund is the wrong place to do it. That's a much better way to go. You have a sort of national super fund, two moves away from government. So the government appoints a body, an independent body, and that body then appoints the independent people running it. And that's the way it's going to end up with a lot of countries. The Canadians have got the big Canadian pension plan, and eventually that will be the fund that people go into. And performance, the competition is meaningless. It just means that you end up copying everybody else. So why have so many then? It's crazy. And the cost is enormous. And of course, everyone, when you talk to super funds, of course, they're all terrific. Well, we all say that about ourselves. And when you talk about their boards, we've got a terrific board. It might have 37 people on it, but it's a terrific board. They are the super funds below. They have done the industry funds have done a hell of a lot better than the for-profits, and they always will. They've still got their problems that they don't want to address, and that's one of them. And the relative performance is it's a meaningless thing, but you can see when I was a CIO, that was always the first thing they wanted to know. There were two questions: how have we done relative to AusSuper or somebody? Who cares? Would have been my answer. And then the second one is, what happened in the market today? And there I did say, I neither know nor care. And, asking the right questions is a key thing for these funds, and it's not clear that they do. But anyway, they've gone the relative performance. Yeah, it's a really empty thing. And yet to break it, and the whole industry is geared towards promoting it. So there's a real problem there. I don't know how you get away from that sort of thing.
You've raised a whole range of issues there around sort of, the more of a national style fund or one or two major super funds. Is that really because you see the competition as being, you sort of describe it as a furphy, and that you'd actually get better benefits from cost and allocation of capital from the system?
I think so. You'd get rid of this relative performance thing. So the investment, the purer ideas of investment would come through, but you also get rid of a hell of a lot of extra baggage. I mean, do we really need all these people? Do we really need, I don't know how many funds we've got at the moment, but still nothing like we used to. Are they really adding value? Some maybe, but then they get swamped by the size of things, and the number of people involved and the cost of holding all those people is a waste. It really is. The banks, at least there are only 4 big major banks. You could argue that probably only need 2. There are a bunch of other ones. I don't know what they do really. They say they're special. One of the things is you could be more specialised. You don't need all these if they're all the same. So is there a way for these funds to distinguish themselves, to specialise in some way? Well, the smaller funds could do that. Smaller funds are in a position of saying we are not going to be like them. That's got a business risk associated with it. But boy, there are some advantages in being a smaller fund. But and there should be some. And this absurdity that you've got to be large it denies the fact that scale, so there are obvious advantages in scale and there are obvious disadvantages. And the people who argue for, like the regulators, seem to ignore the obvious disadvantages of scale, of complexity, for instance. So I think there's a scope for a bit more specialisation amongst super funds, having some small ones.
Is having the small funds really sort of critical to sort of maybe tailoring these funds to their members? That's sort of been always the discussion around sort of the media supers of the world, and they feel that they understand their members, they understand their industry, and there's that broader connection. Is that sort of what you're talking about?
Well, but that's another furphy. Most members quite intelligently are not interested in this. When I say it's intelligent, it's not. People don't understand super, and it's not because they're dumb, it's because they're smart. What do you want to know about? Why would you want to know much about super? Do you trust the system to actually do what it's meant to do? By and large, yeah. And what are you going to do about it? There's nothing you can do about it. It's engagement is really an empty thing. This is something you're dealing with your retirement money 30, 40 years in the future. It's all automatic. There is no, what are you engaged for? I've never understood that. I personally never look at my super account. What am I going to do when I look at it? Oh, it's up. Oh, good. It's down. Oh, that's not too good. What's the point? And so until you get closer to retirement, of course. So I don't think this idea of being close to them really adds much at all, you're not going to get much. No, I think the small size has just got the advantages of being able to do different things and capitalize on investments when smallness is an advantage. That, for instance, a lot of private equity is relatively small, and so the big guys can't really do much there because they'll just swamp it. So that the small guys can take that advantage. Mm-hmm. So no, I think I don't see being close to members. I've not understood what it is. The banks all say that. Of course, everyone in business says that. And how many are believable? So there's a lot of, like any industry, there's a lot of crap about it that I guess some people believe, and most of us probably understand that it's part of the bullshit that goes with any organisation, unfortunately.
Let's come back to one of the conversations that questions that you asked around sort of being at SunSuper and the board questions and asking the right questions. What does that mean to you? And I guess what are the right questions that boards should be asking?
I think that's one of the key things for boards, and that's true whether it's in super or any other industry, to actually, particularly when you're dealing, as most boards do, they are non-experts dealing with experts. It's the same with government, which offers a good analogy. How does a minister who is not an expert, how does a minister get the best out of his expert civil servants and advisors? It's a tough question. I don't think it's a question that's been asked enough of. Some people can do it well, I think. I think Keating eventually did. When he first became treasurer, he really literally knew nothing about the economy. But he learned quickly, and he learned how to get the best, I think, out of the advice. Boards don't, on the investment side, they don't know what questions to ask. I once had a board that asked me that, said, can you come in and lead a discussion around what questions we should ask our internal investment staff? I think that's a great question. That how should we query them? And what happened was exactly what happens with all these boards. I went in and they said they'd give me, an hour and then an hour over lunch where we could discuss more. And then you go in and they say, oh, I'm sorry, you've got 20 minutes because something urgent's come up. Now that indicates, and that's before I started, so it wasn't a reflection on how inadequately I did it. That is so typical, that they are so concerned with the short-term questions that have immediate answers. That's what boards tend to want, or the people who are put on boards. They want short, snappy, quick answers. And that is not the way to understand what's going on and therefore really direct it, which is what you're there to do. Somehow, as a non-expert, direct the experts. And there are people who can do that. It's rare, but there are people who can do that. And I don't think we know enough about how to do it. So the question that boards always ask, how's relative performance? Forget it. One of the things I did at SunSuper way back when, they used to ask that question all the time. And I said, what's happened in the last month is irrelevant. I'll tell you what I'll do. I'll set it up in those days on I think it was email or something. I'll set it up so that you as directors can go in at any time and see what the relative performance is. All you have to do is click a few buttons, and I made sure they could do it. And they never did. And that really tells you something. So why do they ask that question at the board? They were not interested in it. But once you're at the board, they feel there's the camaraderie around a board. There's always, in any grouping, there's the issue of I'm going to show off in front of somebody else. That's true of all organizations. But they're the wrong questions. And what the right questions are, well, that's the really big question. but it's certainly not what did the market do today. That is dreadful. There are, but not all the boards are like that. Of course, some are better than others. But I think those are governance issues that they probably don't spend enough time on, and they don't give enough time within the board meeting. Another one that I had a lot of experience with was investment beliefs. And to me, that's a critical thing to start off with, to actually think through, work through, and develop what your beliefs are, and to then, in an ongoing way, make sure that that's what you're doing or changing rarely if necessary. The CPP, the Canadian Pension Board, spent, I think, 2 years, maybe 1.5 years, developing their beliefs before they even invested. And they spent a lot of money on that, and that's what they did. And they had a very good board that was part of being a very good board. Boards here, no, we'll get a consultant to write down what our beliefs are. Thanks. What's next? And so they never really believe the beliefs. And we know that that's a critical thing for good investment, to have those and to understand them. So they tend not to ask those questions.
Can I ask a bit more specific? Can I ask a bit more specifically around sort of the board makeup around, so you talk about investment beliefs and diversity there. If you look at most of the makeup of boards of the Australian super funds, most of the people are Australian. They've been through the Australian education system. They've worked in Australia. Some have worked a little bit overseas. But do we actually need to maybe broaden out those boards and really have people from different parts of the world? Because, if you speak to someone in France about their investment philosophy and their view of the world, it's going to be very different to someone who sits in the US, someone who sits in Hong Kong, someone who sits in Australia. Is that part of maybe one of the things that we should be looking at in terms of building diversity?
Definitely that. I'd take it further. It's different mental models. Mm-hmm. If that's Charlie Munger has always said, Buffett's partner has always said, the most important thing to have in investing are different mental models, to have different ways of looking at different things at the same thing. And most of us, of course, and that's true, as I say, most of us have been trained to think of things in one way and find it not only very hard to think in another way, but also very easy to shut down anyone else who does think in different ways. And yet that is the absolute key. It's diversity of mental models. But boards, by their very nature, or you hear it from the super funds all the time and from normal companies, what we want, we've got harmony. We have a harmonious board. Well, that probably indicates it's the wrong board. It's the same with democracy. You see ScoMo, who's got intellectual content of a used house brick, and he's saying how we want quiet Australians. We don't want these Australians out there demonstrating. We want quiet Australians. A good democracy, a healthy democracy, should be filled with noisy dissent. If it's not filled with noisy dissent, it's not doing its job. And to an extent, that's true about investment for the same reason. And the reason is the massive uncertainty that governments are dealing with and that people are dealing with and that boards and super funds are dealing with. And you need those different mental models, and they're hard to get. That means you've got to appoint people to boards who don't fit, and that's the last thing they want, because then you become the board arsehole. You've got to have people who don't fit and who are encouraged not to fit and who are recognised for having those different views and can learn how to try to influence people. And that is anathema to most boards probably around the world. And one of the ways you get that, what you're saying is true, is you get it by being broader and being educated somewhere else and so on. And but that it's a hard thing to do. It's a very hard thing to do, particularly when there is a very strong individual. Now, I speak from experience of Jeremy Grant. He encouraged different views, but he really was, his intellect on investment was second to none. was a great debater, so he had very strong arguments against you and in favour of his own view. That's a very hard thing to do. Often wrong but never in doubt. It's that sort of thing, but that's what you've got to do. That's the way. But you don't have to do that if it's a relative game. If all you're worried about is doing what everyone else is doing, you don't have to do that. There was a balanced fund in the UK some time ago that did the following. They took the asset allocations of all the funds, all the balanced funds that were reported every month. They only got that a month in arrears. They then projected what they thought the fund had done, how they might have changed their asset allocation from that previous month to now, which wasn't hard to do given what the markets have done. And then they averaged that, and that was the asset allocation they'd take for the next month. And that worked pretty well. So if you're going to be worried about relative performance, do that, or just buy an index fund. That'll keep you sort of in the top half or something. Mm-hmm. And then you avoid all of this stuff. But that's wandering away from what boards should be doing. The key, I think, is what Charlie Munger said. And all the great investors say the same thing, that you need different ways of looking at things. Mm-hmm. One of the things going back to what we did at GMO, of asking how could we be wrong, that's a key thing that you've got, and that's a key thing to do. But it's painful to do that because there'll always be ways you can be wrong. And somehow in investing, you have to have, knowing that there is a high probability that you're wrong, you still have to take decisions, and sometimes very big positions. And that requires a certain temperament. And I don't think many people on the boards or many people in the world have the sort of temperament that can deal with that and make tough decisions in the face of uncertainty. And that's what we want governments to do. And then, of course, you know what happens when they get it wrong. They get abused for it. That's part of the reason, going back to this relative thing, it's part of the reason why governments and people in government very rarely say anything or want to do anything. Because we, the people, abuse them when they get it wrong. Instead of understanding, we haven't done that with COVID, interestingly. COVID was an interesting case where I think Australian governments of all tenors actually handled that well. They accepted some of the science that was uncertain in itself, and they made some tough decisions, some of which were right and some of which turned out to be wrong. But that was very much like investing. And they did it well, so you can do it.
One of the questions that comes, to mind when you sort of talk about these sort of broader issues that are inherent in the system is how do we actually instill courage into decision makers? And it's not just the board, but even some of the investment professionals as well.
Very much. Well, and how do we do it in society and in government? How many people have that sort of courage or are willing to stand out and take the risk of being wrong and alone? Because that, as Keynes understood 80 years ago, that's the big risk in investing, of being wrong and alone. If you're wrong with everyone else, you tend to get the comments there that's all right. Well, everyone was in the same boat. Obviously, you couldn't do it. If you're right and alone, you get a little lecture that you got away with it this time, but don't do it again. And so that lack of courage is, you're right, it's there everywhere. It's there it seems, maybe it's intrinsic to a community. We are, after all, herd animals. We do like being the same as others. We do want to conform. You look at little kids and you can see the strength of it. And there's a great strength in that sort of conformity because it keeps the community together. On the other hand, if that's all that we did, we'd never advance. The classic sort of faux model is going back 200,000 years ago. We've got a tribe running through the the felts of Africa, and we've gone on this path every time. This is to get some food. We've always gone in, always come back, and it's been okay. And one of the members says, "Why don't we try something new? Go that way." And the guy who does that, on the one hand, runs a big risk of being chomped by a saber-toothed tiger. On the other hand, he or she might also find a new and better way around. And that, in a way, has to be rare. If everyone did that, there'd be no community, there'd be no herd, there wouldn't be the strength of the community. So in a way, those sort of courageous people will always be small in number. And that's fine, but you've got to find them and you've got to give them the opportunity. And that is the challenge. That's really hard. And it's not just investing. It's probably true in football games. Well, we know it is. The coaches who try different things usually get abused. They may not work, and they get abused for it, and they pull back and do what everyone else is doing.
And you can't have five strikers or 5 goal kickers.
Exactly that. It's true in art. The Impressionists who started Impressionistic art in Paris in the 1860s, where they had that amazing ability to take a bit of paint on a bit of canvas and make it look like there was water shimmering in the sunlight with a bit of paint. I still find that staggering that anyone could do that. And they changed the way art was. Art was traditional. It usually had a religious element, and there were traditional things you could do. And these guys, Monet and the others, they changed the way art was done. But boy, did they have to take courage to do that. They weren't allowed to show in normal places. They were dismissed as being heretics, as this isn't art, which is the usual thing to say. They had to do it by themselves and live with that. They didn't make money out of it. Think of Vincent van Gogh and others. He was a bit late to it. So even in art and music, it's all the same. And I think that sort of mock sociological reason I gave has got a lot of truth to it. That we do get comfort from the herd. We do get a lot of strength from the community. We are social animals. We cooperate. I know the neoliberals don't want to know that, but we are as competitive as we are cooperative. And even there, it is hard to be different. It takes a certain temperament. Jeremy Grantham was that way, and the concern that we all had and he had was, is he doing something, say an investment strategy that's different to everyone else's? Is he doing it partly because he likes being different, that he gets a bit of a buzz out of standing alone by himself? If that's why you're doing it, that's the wrong route. Mm-hmm. So the psychology of investors plays a big role, and again, boards don't seem to be interested in that.
I'd like to come back to one final sort of question that ties up a whole lot of this herding and courage and so forth. And it applies to ESG and climate change because it feels that there's a bit of a herd that's within that space. And it's really, becoming this big part of superannuation. Every fund is waving the flag of it. Yeah. I wanted to get your backdrop in terms of, is that really, when you think about a fiduciary responsibility and the role of funds and then their duty to sort of manage climate change and ESG, I really wanted to sort of get your feeling, because there comes a lot in terms of courage, managing a herd, what's the role of super, and what is the market issue here as well. So if you could bring that together.
Yeah, on the negative side, there's no doubt that this industry, in investment industry, is very fashion conscious. It gets driven by fads and fashions. If you look back at the history since I've been in it, which was sort of the late 80s, there are fads and fashions that sweep through the industry like any other industry, I guess. And this is certainly, there's no doubt, this one of the fashions that everyone has to do. And again, it's the relative stuff. If the super fund down the road's doing it, I've got to do it. Now, having said that, there are some. That's the sort of superficial response, but there are deeper and more meaningful issues there involved. And I'm in two minds about it. I think one of the things I do respect is the sole purpose test. And the sole purpose test says very clearly that as a trustee, as a fiduciary, you've only got one purpose, and that is the financial results for the members. That's it. Maybe that should be changed a bit. I don't know. And so that, for a while, that concerned me, that it allowed the funds to do all sorts of things that weren't really in the members' best interest. When I was at SunSuper, and that was some time ago, we had an ESG fund and no one wanted it. Now, maybe that's changed a bit, but there's a bigger issue. And the bigger issue is climate change, climate crisis is, unless you're a Donald Trump or a Tony Abbott or some of those ideological people, climate crisis is the biggest crisis we face. And it's been obvious for 20 years, and our leaders have not shown courage. Rudd did. He said it's the biggest moral issue of the generation. It is, and then as soon as there was a bit of political pressure, he went to water. So there's no question this is something that can destroy our society. It's already destroying our societies. The way to solve that problem is coordinated global government action. There is no other way of solving it. That's what it has to be done. It's taking too long to do it, but maybe we are. Getting super funds to vote one way or another, and it's never clear what they're doing, is digging at the edges. It makes them feel good, but it's not really attacking the problem. And it may well have the effect of the human effect, like turning lights off. All right, you feel good, but maybe by feeling good for doing something small, it takes you away from doing the really important things. Because hell, I've done that. I segregate my rubbish now. I don't waste things. Well, that's not the answer. The answer has to be coordinated global government solutions. By doing what the funds are doing, they are making it easier for governments to say, well, look, the private sector's dealing with it. And in the current climate, the ideologically driven right wing wants any excuse they can find to reduce government and to reduce government involvement and government action. Anything they can find. And this gives them an opportunity to say, well, it's not our issue, we'll let the market decide. That is a real problem there. And governments are doing that all the time. That's part of the privatising. I personally believe in having public assets. I believe in having a strong and large government, not a small one. It's got to be good, of course, and to tackle questions like this. There was a case recently where one of the big industry funds was asked how they voted in favour of some management proposal that various ESG bodies had said they should have voted against, and they voted in favour of it. And they were asked about it, and they said, we believe in engagement. Now, really? You're going to go to BHP and you're going to engage with them, and that's going to have an effect? Come on, you own 2 basis points of the company. There's nothing there. So it's got its problems. On the other hand, there is very clearly, when it comes to the risks, very clearly there are risks involved. And therefore, funds have an obligation to worry about these risks. In America now, if you have a house near the water, you will struggle to find a 30-year loan, because then there's a real risk that's happening right now, as we've seen. So funds certainly have a responsibility to do that, but that's doing it within the context of the sole purpose test. It does raise the bigger issue, and the bigger issue is about the whole economy. Do you believe in the market-driven economy? And if you do you take Friedman's view that the sole purpose of a company, of a corporation, is to make legal profits? That was his view. That is so wrong on so many grounds, and yet it's so believed, particularly on the right. It's wrong for one reason, that as a director of a company, legally, my responsibility is to the company. End of story, not to the shareholders, to the company. And it's left vaguely like that. Does that include the employees? I would hope so. Does it include the community? I would hope so. Does it include the bondholders? I would hope so. That's the change that's going on right now. And I hope we win that change and get away from this narrow, ideological, market-driven nonsense. There's even the Chief Justice of the Delaware Supreme Court has come out in favour of a broader view, call it stakeholder capitalism if you like, a broader view of what your responsibility as a director and as a company is. And once that gets more accepted, then the problem gets even murkier than it is now.
All right, that's been a fantastic conversation. Thank you very much for your time today.
Thanks for the opportunity.
Thank you for joining us. All views expressed on this podcast are subject to change and do not necessarily reflect the views of Conexus Financial. This podcast is for educational purposes only and should not be relied upon as investment advice.